someone earning £100,000 pays a marginal rate of income tax, as in the tax they pay on the next pound they earn, of 62%. It's much sexier to have grand utopian solutions about taxing other people and raising vast sums of money. And that's why my message is always going to be less popular than the wealth tax. But it's also why the wealth tax is never going to be implemented. So we're talking about 10,000 or so people in the UK, a very small number of very highly mobile people, annual land value tax. Which is another of these policies that tax wonks across the political spectrum think is a good idea, politicians across the political spectrum think is an awful idea.
Hello and welcome to the Institute of Economic Affairs podcast. I'm Tom Clougherty, Executive Director here at the IEA, and today I'm going to be talking to Dan Neidle. Dan is fast becoming one of the UK's most respected tax experts. He's a former city lawyer turned policy researcher, and his firm Tax Policy Associates is really doing great work in this space. Today I'm going to be talking to him about pro-growth tax reform, about what we might expect from the government at their budget this autumn, and various other things besides. Dan wanted me to mention that none other than Richard Murphy has just described him as God's gift to neoliberal tax policy. I can't imagine a better endorsement than that. So you run Tax Policy Associates. Before you ran Tax Policy Associates, you were a partner in a city law firm. You were doing tax law. And I'm kind of curious, just as an opening question, did you become interested in tax policy through that professional endeavour because you were working on tax a lot? Or did you become a tax lawyer because you found tax so inherently fascinating?
Typical lawyer answer. Both. It depends. So why did I become a tax lawyer? I think the 20-something me would have been appalled at the idea I became a tax lawyer and couldn't possibly understand it. But if we are interested, as I was, in economics, law, politics, business, the place where they all collide, normally very messily and unsatisfactorily, is tax law. So as a lawyer who has those interests, it's tax law feels the best possible fit. So I was always somewhat interested in tax policy. As I became a partner, I became a partner in 2008, which is at a time of pretty much tumultuous events in law, tax and politics. And clients would increasingly not just want to know what the law said today, they'd want to know, well, where's the law going to go? And what are the possible options and how might it play out? So over time, I became a lawyer who would advise a bit on tax policy, probably about 10% of my practice, because horrible secret for anyone listening, clients love tax policy. They really want to hear about it. They never want to pay for it. So you cannot make your career as a lawyer, I believe, doing tax policy, but you can do it on the side, and that's what I did. So when I retired, I wanted to keep doing legal stuff. I also had a pipe dream that I could make a small difference in making the media coverage of tax less horribly superficial. So that became Tax Policy Associates.
Yeah. And so your mission really is to improve tax policy, but also to improve the public understanding of tax. I mean, what do you think some of the biggest misconceptions are that are out there? I know you've done some polling and so on. What do people just get completely wrong?
It's hard to know where to start. I don't sound like I'm just a whiner, but I mean, fundamental things like half the public, it seems, doesn't understand how tax thresholds work. The idea that you pay the basic rate, 20%, until you're earning 50 grand, and then past that you pay 40%. But if you earn £50,000 and a penny, you only pay the higher rate, the 40%, on that additional penny. But a large number of people, possibly as high as 40%, think that once you hit that threshold, you pay the tax on everything you earn. So you're worse off. There's been lots of polling done for decades in the US revealing that Americans think like that. And I thought, well, the British aren't going to make that mistake, are they? And I was a bit surprised and depressed to find out that, yes.
Yes, they do. And I mean, do you think that politicians benefit from this public ignorance of how the tax system works? Do they take advantage of it in certain ways? Or would life actually be easier for policymakers if the public had a proper understanding of the tax system and how it works?
I fear I'm going to try not to be too downbeat throughout this. I fear it's a bit of a death spiral, that public misunderstanding feeds political cowardice, feeds more public misunderstanding. So the absolute classic of this, which for years I thought was an urban myth, is from some point in the early 90s up until just a couple of years ago, the Lib Dem policy was to put 1 pence on income tax for extra spending on education. It was wildly popular. It was the most popular of their policies, real flagship of their policies. And people used to say, yes, but people support this because they think it means they're paying 1 penny more tax, not 1% on all their earnings. Ha ha, very, very funny. Can't be real. But I've heard it from a very reliable source. I don't think it must be naming him, Daniel Finkelstein,
right,
who was in the Tory Party research department at that point and who saw the polling confirming that that's what people believed it meant.
Wow.
So hang on a second. This means that you had a flagship policy being wildly misunderstood by the public. That can't be good for anyone. I'm certain it wasn't good in the end for the Lib Dems, but it's bad for tax policy.
Yeah. And I mean, I think you've done some polling on actually, 'cause it's often said people are willing to pay more tax to fund public services. And I think you've done polling on this and you find that it's true, but with a fairly important qualification, right?
Yeah, we want to do some more polling on this. But what we said is, are you in favour of increased tax to, I think to be spent on the NHS. We didn't say what in the NHS, but we said the NHS. And about half the population is.
Right.
We then asked, okay, are you prepared to pay more tax yourself? And this is from memory now, about 60% of those said yes. And lots of people have done research like that. It's not very surprising. But then we did something which, oddly, nobody seems to do, which is say, okay, how much more tax are you prepared to spend? And the answer turns out to be, for most people, about 50 quid a year.
Right. So about 30% of people would pay an extra 50 quid a year to fund public services, but that's sort of as far as they're prepared to go.
Yeah.
I'm not holding you to those specific numbers.
It's something like that.
The...
Quick plug for the Tax Policy Associates website. Yeah. It has the accurate statistics that I clearly can't remember and all the polling data. But I mean, I fear there is that in part, no doubt, that reflects that people don't want to pay more tax. Surprise, surprise. But in part, I think it reflects a lack of understanding as to how the tax system currently operates. And we're about to publish some data about how the UK compares internationally. If you ask people, almost all of them, from someone on minimum wage to a billionaire, will say they're overtaxed.
Yeah.
And it's certainly true that overall tax in the UK is higher than any time since the 1940s. But it's also true that for a median worker in the UK, they're paying less tax on their earnings than at any time since the 1940s. It's also true the median worker in the UK pays less tax on their earning than their compatriots in most other countries. So there's a whole bunch of contradictory things out there which aren't widely believed, and politicians kind of feed it. You will look high and low before you find a politician who's willing to come out and say they believe in expanding the state by raising tax on normal people. It's always not normal people. It's always someone else. And you're on the other side. You will look high and low to find someone saying they're willing to cut tax paid for by cutting this specific service.
No, I mean, I think that's sort of a fair challenge, really. And I mean, you're right, because I've looked at this myself, and it is quite striking. I mean, there are some variations. I think if you look at different types of family unit and the tax they pay, the UK for the kind of the median worker will look very good if they're an individual, single person, no children, etc. If you compare, say, a single earner household with a couple of children in Britain, median wage again with France, Germany, the US, we look a lot less generous because we only have...
We should see the... I think we're probably publishing this tomorrow.
Okay. I mean, I made a change since I last looked at it, but I did a report based on the OECD numbers, which didn't look great from a kind of family taxation standpoint.
To make it a fair comparison, you have to take cash transfers into account.
Right.
So that means you have to take child benefit into account.
Yeah.
So in, say, France, there isn't an equivalent of child benefit, but the tax system favours people with children. So to compare like with like, you really have to take child benefit into account. And once you do that, you see that it's significantly less tax in the UK than France.
Interesting.
Even for a couple with a single earner and 2 children, but also for a couple with dual earners and 2 children. We will publish all the stuff on this tomorrow.
Well, I'll be very interested to see that. Yeah.
I'm sure it will completely change the political landscape, and no one will ever complain about being overtaxed again.
No, quite. But I mean, this is an important point, isn't it? That we've got a very high tax burden overall, by historical standards at least, by British standards. And I guess people still feel like they're being heavily taxed, probably because real wages haven't risen significantly in 15 years and life hasn't really got a lot cheaper. Quite the opposite, in fact. But that does put you in a bit of a bind, right? Because, and I talked about this with Paul Johnson, that the tax system has become much more progressive over a period of Conservative-led government.
Yes.
The Tories don't want to talk about that. Labour don't want to talk about that. But nevertheless, we're much more reliant than we used to be on high earners or higher earners and everything else. So the tax system is getting more and more top-heavy. People in the middle are paying relatively low rates,
they're paying
internationally speaking.
Well, they're paying less than they ever used to because the basic rate of tax is less than it's been in the past, 20% compared with 35% in the 70s. And the personal allowance, whilst it's been held for a few years, is still several times what it was in the past.
There's probably a political economy problem here, right, isn't there? That if the tax system, I mean, it's one of the downsides of a tax system becoming more and more progressive, is that everybody else can try and, I suppose, vote themselves more spending at somebody else's expense, if they're not seeing the burden on themselves as directly. And I guess you see that in an awful lot of proposals. People want to raise public spending, and there's normally some way that they can raise taxes on the rich or on businesses or whatever that won't have any negative economic effects or miraculously raise tons of money. And no ordinary person, or no worker, or whatever, however you want to put it, will have to pay more. But that's kind of a fantasy, isn't it?
Yeah, I think the two, probably, I am not an economist. What's the phrase? Some of my best friends are economists. And maybe the two most significant things that I ever learned from economists are, first, incentives matter.
Yeah.
And hang on, what was the second one? The first one is incentives matter. The second one is there are always trade-offs. All policies, unless you can snap your fingers and create hugs and bunnies for everybody by magic, there is always a trade-off. And when I see tax policy proposals that don't think about incentives or don't discuss trade-offs, then my hackles are immediately raised. I mean, they may still be good proposals, but if you're not even thinking about the potential downsides, then it's quite hard to take them seriously. A problem we have is that low tax on the median worker has been purchased at a price. Part of that price is one that most people may think is politically acceptable, which is that higher earners pay more tax. But part of it is that there are now taxes, the incidence of which falls on normal people, which are much higher than they used to be. So probably the greatest example would be stamp duty, stamp duty land tax, where we are significantly reliant on stamp duty land tax more than most of our international competitors. And obviously people feel that. But somehow there's never been any political pushback as governments have successfully raised it. I think finally we have, congratulations government, discovered the top of the Laffer curve here, because there's general recognition that it cannot be raised anymore without losing revenue. But it is so high that it distorts people's decisions when to move, where to move, and whether to move in search of jobs. So that has an absolute downside on normal people. You won't see it in the tax wedge figures I'll publish tomorrow, but it's one of the many trade-offs that the trends in UK tax have created.
Interesting, yeah. And I mean, I want to talk more about property tax, and maybe we'll come back to that in a little bit more detail. But you were saying sort of things you've learned from economists, and something else that I see in a lot of your writing is a focus on the economic incidence of tax. And so you've kind of just referred to that with stamp duty land tax, but it seems to me you see it as a more generalized problem that, we talk about employers' national insurance contributions, for example, as not being a tax on workers, when very clearly, at least the majority of the incidence, if not all of it, or close to all of it, is going to be on the worker. Do you have much success making this argument and trying to get people to pay more attention to the economic incidence as opposed to just the legal incidence?
The problem with economic incidence is, for someone who's steeped in it, it's extremely obvious. For someone who isn't, it's deeply counterintuitive. So I get people sending tax ideas to me all the time. Sometimes they're brilliant and sometimes they're rubbish. I had one the other day, which is to have a tax on all bank transfers. This person had looked at the total volume of transfers between bank accounts in the UK, which, as you'd expect, is gargantuan, in the trillions. Multiplied that by some small percentage, 0.2% or something, and said, ta-da, we can raise £200 billion from tax and the banks will pay. But hang on, the banks won't pay them. I do try and respond to all the emails I get. I was quite busy here. I just sent a one-line response saying, the instance of this is going to fall on customers. And he said, no. It'll be the banks who are legally required to pay it. The banks will get a bill and they'll have to pay it, so it can't be passed on to customers. And in the real world, it doesn't work that way. How do we know it doesn't work that way? Well, ordinarily, an economist would look at where you can substitute for other products, how competitive the market is. And the answer when it comes to bank transfers is there kind of is no competing product other than hoarding cash. So people would have nowhere to go. So logically, the banks are going to pass it on. The other way to look at it is if you look at total bank profit, you'll find that the banks couldn't shell out another 200 billion if they wanted to. The figure is just too large. So it has to be passed on. But either way, it's a counterintuitive result to people. Not only that the instance, if you develop such a tax, wouldn't fall on the banks, it would fall on the customers, but that you can't change that. It seems frustrating. Well, let's make it happen. Let's make the banks eat the cost.
Yeah.
How? Well, there have been attempts to do that. In India, they had some change in India. I must be getting old. They had some change in Indian law, which I cannot remember. Yeah. And it was accompanied by a law that said that it couldn't be passed on to customers. It had to be borne by business. And a body was created to adjudicate whether or not it was being passed on. And of course, it's impossible to tell because if you look at any price of any product, it's kind of crazy wobbling up and down with a myriad supply and demand factors that no one in the world can actually understand. So to isolate out of that whether a particular tax is being passed on is impossible. And this body ended up just making spurious and politically driven decisions, as it always would. So it's a long way of saying that instance is quite counterintuitive. The best way to explain it, I always think, is VAT, because I think everyone is used to the idea that they pay VAT, that if VAT goes up, then prices go up. But of course, if people think about it, you realise that you are not literally paying VAT. When I go out and buy a chocolate bar, I am not writing a cheque to HMRC as I do it. The shop is paying HMRC, and the shop doesn't have to add on anything at all. When they sell me the chocolate bar, they could add, they could take money away. They could add on the full 20%. They could do anything in between.
Yeah.
But you know, and I know that if VAT goes up, then sure as eggs is eggs. Most or even all of that is going to be passed at an increased price. So there is a clear split, I think, that no one could argue against in VAT. But in the legal instance, the shop, and the economic instance, largely, mostly, sometimes, occasionally, always, depending on the facts, the consumer.
Yeah. So there's, I mean, obviously you received some wacky tax suggestions in your inbox.
And some great ones.
And some great ones too, and I get some of the same. But I mean, more mainstream ideas, although maybe still on the fringes, have, I think, similar characteristics. So, I mean, that tax on bank transfers, for example, bears some resemblance to the financial transaction tax or Tobin tax, which has been talked about for ages and always sold as, I mean, the amounts of money it's supposed to generate are extraordinary. It'll solve all our problems, and yet no one will really notice. There's no trade-off, etc.
Yeah, and no incentives. This is again a classic example of we've worked out there's this much of stuff, and if we tax it yay amount, then obviously we will raise amount of stuff multiplied by rate. Ta-da! And there the presentation ends. And I say, well, okay. I calculated that in the UK there are 5 million men with beards. Let us introduce a £1,000 beard tax. That will obviously raise £5 billion, won't it? What's the answer? How much would it actually raise? That's quite an interesting question, because obviously not £5 billion, because, shocker, people will cut their beards. But not everyone will cut their beards. Some people will forget to shave their beards and pay the tax by accident. Other people may choose not to shave their beard or even grow a beard as a sign of their wealth. They're so wealthy that they can afford to have a beard. So the amount you'll collect from this will not be zero, but it will certainly not be £5 billion. Now, beards, you might think it's a trivial example, although I think many of the men listening will not think it's a trivial example. But financial transactions, the same. You tax something, you will inevitably get less of it. And often that's the point. Tobin in the 1970s thought that the post-Bretton Woods foreign exchange market that developed was dangerous, evil even, and he thought that if you could throw some sand in the wheels of it by having a small tax on every foreign exchange transaction, you would bring that market lurching to a halt. That was the idea. He wasn't trying to raise tax, he was trying to stop the market. So people take that idea now and say, aha, we can use the Tobin tax to raise money. They're missing something very fundamental and something that was in the very origins of that tax. Tobin wasn't a fool, but sadly many of the people proposing it now are.
And I mean, the nice example here at Lord North Street, the IEA, the front of our building has several bricked up windows. I don't know if you noticed that on your way in. Obviously, a legacy of the window tax.
I'm going to have to put on the nerd voice here and say, no. Actually, that's not quite right. They're not bricked up windows. They're windows that were never unbricked. It is not the case, as far as it's known by historians, that people did brick up windows to avoid the window tax. You weren't allowed to. However, when people built new houses, they anticipated the window tax being repealed because it was such a stupid tax. Clearly wasn't going to stick around. It did stick around for over 100 years. People didn't think it would. So they built houses with bricked up windows in place as they built them, thinking they would unbrick them up when the stupid tax was repealed.
Yeah. Well, something tells me our grade 2 listing won't allow me to unbrick those windows now.
You have zero chance of unbricking the windows. And that's why there are so many across London. But that illustrates a kind of another nice element of tax. That if you introduce a tax which people believe won't stick around, their response to it will be different for a tax which will stick around. We see this with things like raises in capital gains, where the taxpayer response to it is often heavily driven by the thought that the rules are going to change again in a few years. And since they have changed so many times, that's rational. So Labour didn't actually change capital gains very much. They put it up by 4%. But let's say they doubled the rate of capital gains tax. I think a lot of people sitting on large gains would have just sat on those gains and waited for a change in government.
Yeah. And I think in that circumstance, it would be quite easy for an opposition party, if they were a credible opposition, to say, we're going to cut that rate in half when we get in. And then lots of investors might think, well, I'll just sit on my capital gain and wait. It's worth hanging on, not realising any of the gains as a result. And I suppose then you can prove your own point in effect by introducing that degree of uncertainty. The other sort of silver bullet tax policy that I wanted to raise with you is the wealth tax. Now, that's the one that seems to have reared its head quite significantly recently. People seem to have stopped talking about the financial transaction tax. By the way, with financial transaction taxes, 2010s, people always seem to forget that we have a financial transaction tax. Even David Cameron, when he was opposing a financial transaction tax at the European level, seem to ignore the fact that we have stamp duty on shares.
God, I'm going to be a pedant again. This is getting a habit. So I'll tell you there's a difference. So a financial transaction tax has a particular feature, which is that it cascades, meaning that any financial transactions, certainly FX transactions, certainly transactions in shares, it's not just me selling to Sam. I sell to a broker who sells to a market maker, who sells to another market maker, who sells to your broker, who sells to you. Multiple steps. A financial transaction tax taxes at every single stage. And it does that because it's trying to kill liquidity. It's deliberately trying to do that.
Yeah.
Stamp duty, on the other hand.
What if you're doing it the Tobin way?
But then I think if you don't, it's not a financial transaction tax.
I see, okay.
To real existing taxes like stamp duty and the sort of confusingly named FTTs on the continent, which were given that name to be fashionable, but are not financial transaction taxes, they apply just once. So they're kind of share transfer taxes in a sensible way, that they're nothing like the Tobin tax. So yes, we have stamp duty. It's a problematic tax for a bunch of reasons. Maybe we can get onto that. Yeah. But it's not a financial transaction tax. And whilst its effects are damaging, it is nothing like, in effect, an FTT.
A full FTT. Yeah. Okay. I mean, we'll stick with that for a minute because you've said that we should abolish stamp duty on shares, and that it probably wouldn't cost much money. Might even generate more revenue in the long run if you got some growth effects. I mean, how strongly would you push that idea? If government came to you and asked for advice, how high up your list of things to do would that be? Is it just an easy win, or
so
an obscure interest?
Transaction taxes generally, I think we should abolish because any tax stops you from doing the thing that's taxed. Transaction tax stops transactions. We don't want to stop transactions. Stamp duty has the other unfortunate feature that it doesn't stop all transactions in shares. It tends to stop transactions in shares of UK incorporated companies.
Right.
So hang on, why are we making it more efficient for me to invest in a foreign company than a UK company? How is that in the interests of the UK as a whole? And then you get to the bigger question, which I don't have the expertise to answer, which is what would the net economic effect be if we did repeal stamp duty? And there's a study by the Centre for Policy Studies and some economists, which is, I think, a serious study, and which concludes that the effect would overall be more or less flat.
Yeah.
because you're both in terms of the GDP growth that it creates, which is small but real, and in terms of the capital gains tax that you get as people now become more free or feel more free to sell shares. So is that right? Would I stake my life on it? Wrong. No, it's not my expertise. So maybe the answer is for a cautious politician to drop stamp duty by a little bit. So see what happens. You could have a staged elimination. That has a rather nice effect. You're not just giving an immediate one-off boost in valuation to current holders.
No, that's interesting. I should confess that I commissioned that CPS modeling. So I'm so glad you described it as credible, although I'm sure the consultancy we use probably deserves most of the credit there. Let's get back to now. Where was I going? I was asking about the wealth tax, wasn't I? Which is it's the sort of it tax at the moment that people, and particularly on the left, are getting very excited about. It's over here. And does it work? Does it stack up? So there are some wild claims made about it.
So there are wealth taxes and wealth taxes. Been wealth taxes for many years in Switzerland. Norway has a wealth tax. There used to be over a dozen wealth taxes across the OECD. Now there's the main ones, just Norway, Spain and Switzerland. But the actual existing wealth taxes apply to people on fairly moderate levels of wealth. Norway, I think, is about £130,000.
Yeah.
And the history has been that they tend to have fairly generous exemptions or holds in them. So the very wealthy end up not paying all that much. The middle classes end up paying a bit, and they don't raise a vast amount. The Switzerland is slightly different. Their wealth tax raises really quite a lot. Again, not the super rich paying, but the middle class paying. The super rich often get special exemptions out from it, kind of not in legislation, but just as a favour. But Switzerland is funny because in Switzerland they don't have an inheritance tax. They don't have a capital gains tax. They have an income tax, but it's very easy to structure yourself out of it if you're an investor. So the wealth tax is pretty much the only way they tax wealth, and Switzerland is still regarded by most people as a tax haven. So people who see the Swiss wealth tax as a model need to ask if they really see the way Switzerland taxes wealth overall as a model, because I think they wouldn't. Norway has a wealth tax that applies to fairly normal middle class people. They don't have an inheritance tax.
Yeah.
So overall, that is still not a bad deal if you're very wealthy. But these actually existing wealth taxes are not the ones that we hear proposed. What we hear proposed is something quite different. The proposals are really the epitome of the idea you can raise a lot of tax by taxing other people, because they only apply to the very wealthy, say people with over £10 million in assets.
Yeah.
And they apply at a fairly high rate, typically 1 or 2%. That is not like existing wealth taxes. They also, on the face of it, have zero exemptions and reliefs. Once more, not like actual wealth taxes. And if you have a tax like that, and you experience a similar level of avoidance and evasion to what you do with current taxes, you raise very large amounts. The figure of 25 billion is often used. But there's always a but. I don't think you can look at people's response to normal taxes and then apply that to a very small number of extremely rich people who see their effective rate of tax greatly increased by a wealth tax.
Yeah.
What do I mean by that? So a wealth tax of 2%. What's 2%? No one's going to notice 2%. Wrong way to look at it. Think of someone whose return on their assets is 8%. Currently, they're paying tax on that a bit less than 50%. So of that 8%, 4% is tax. With the wealth tax, their effective rate of tax is just going up, because in addition to the 4% of the 8% they're paying in income tax, they have 2% wealth tax. So the level of tax is no longer 4% out of 8%, it's 6% out of 8%. So you end up with a 75% effective tax rate. Now that is going to have an effect on people's incentives and the likelihood of them reacting far out of proportion to existing income taxes and capital gains taxes. So I think that's the category error that the people proposing this tax make. On the one hand, they're proposing a radically new tax, quite different from anything that exists, but they think they can use existing data from completely different other taxes to see what its effects would be. And that, I think, is a bad mistake.
And you're probably trying to apply it to an extremely mobile group of people.
Yes, the most mobile group of people.
Yeah.
And just these taxes, and I say 10 million, smart people understand that if you have a wealth tax on wealth of 10 million, then couples will split their wealth between them. So really you're talking about wealth of 20 million.
Right.
So we're talking about 10,000 or so people in the UK.
Yeah.
Very small number of very highly mobile people. And you can get a sense of how mobile they are if you look at the rich lists drawn up by people like the Sunday Times. If you look at those lists, you'll see that most of the people on the list, well, some of them already tax exiles, live in Monaco or wherever. Others, people like the Hindujas, yes, they're living in the UK, but they don't have a multi-generational long-term commitment to the UK. They're here for now. They may not be in the future. And when they are here now, they're spending maybe a couple of months a year here. They're travelling around the world here and there. So for them to spend a few weeks less in the UK is an extremely easy thing for them to do. So that's why it's right to talk about this as being a very mobile cohort. Not just mobile in the sense, they might move from spending all their time in the UK to none of their time in the UK. No, it's the wrong way to look at it. And they move from spending a fair amount of time in the UK to a bit less time in the UK. Extremely easy.
Yeah.
So the wealth tax advocates don't think this through. The smart ones do. I mean, by far most wealth tax proposals are populist junk. The one that isn't, the Wealth Tax Commission report, is extremely detailed and ends up concluding that an annual wealth tax should not be pursued for these reasons.
Yeah.
And because people will avoid it, emigrate, find routes to get around it. What the Wealth Tax Commission proposes is something much more novel and I think from an economist's point of view, much more interesting, which is a one-off retrospective tax.
Yeah.
So it says, okay, congratulations, we're now going to tax you on X percent, not of your assets today, but of your assets 3 weeks ago. Good luck avoiding that.
Yeah.
And that is on the face of it, it's a brilliant proposal, which eliminates most of the objections people would have to a wealth tax.
Some of the objections people would have to a wealth tax. I mean, I think
there are problems with it.
Yeah. Yeah, and there are different reasons why you might be opposed to it. You might just be opposed to the idea in principle. But I mean, you are right. And I do think it's funny because often when people are proposing the kind of annual wealth tax of the sort you've just described, they'll refer to that Wealth Tax Commission paper and say, look, it showed you could raise this much. And I say, well, they say, yes, if you do it as a credible one-off thing. I mean, my argument was always that it's very hard to make it a credibly one-off thing. Yeah. So even if you can actually effectively collect the tax then when you do it retrospectively and you're okay with doing that, I think a lot of those mobile people are going to say and feel sort of once bitten, twice shy. I'm not going to stick around in the UK because they're going to get a taste for this.
I agree. I think having the history of tax is that one-off taxes tend not to be one-off. We've got the Spanish wealth tax on the super rich, which raises a pathetic amount of money, but is nevertheless there. It was supposed to be temporary. It keeps being renewed. There's another problem, which is almost a philosophical one with the one-off wealth tax, which is that it only works if it's a surprise. Ta-da! We're going to tax you retrospectively. Oh my God, I can't avoid this. I can't do anything about it. I have to pay.
Yeah.
That theoretically works. But could a government do that? Could a government really just go ta-da wealth tax retrospectively? Or do they politically, possibly even legally, need to have put it in a manifesto? And I think very possibly they do. And of course, if you are trained in advance, then all the advantages of retrospection go away.
Yeah.
And you get avoided just as any other wealth tax. So I think you can have a retrospective wealth tax which is politically saleable and legal, but then won't be effective. Or you have a retrospective wealth tax which is effective, but I'm unconvinced that it's politically or legally possible.
So possibly a non-starter. Let's pursue this a little bit, though. You know, what do you make of the way that wealth is taxed in the UK already? Because just because we don't have a wealth tax doesn't mean that wealth isn't taxed in its various forms. It's taxed in a variety of different ways. Often the claim is that the wealthy are undertaxed. And I'm not sure if that's true when you look at how progressive our tax system is, when you look at the sort of shares of GDP that revenue from things like capital gains tax or whatever represent in the UK versus other countries. It's at least a much more mixed picture than this straightforward, this is my perspective anyway, we don't tax the wealthy or their wealth.
Well, you're an evil neoliberal. Of course you're going to say that.
Well, quite, yeah. I'll dispute the evil bit, but the other bit is a perfectly reasonable charge. What's your perspective on this? I mean, I know that you think that the way that we tax wealth and the wealthy isn't right at the moment, even leaving aside whether it's too little or too much.
So God, another typical lawyer answer, it depends.
Yes.
So there are types of wealth and types of wealthy individual who are overtaxed. There are types who are undertaxed. So who is overtaxed? At this point, we should start playing a small violin, because let's talk about bankers. So if you're a banker, then you pay, sure as anything, 47% marginal rate on your generous salary and enormous bonus. Used to be that there are myriad ways that could be avoided. Today, there are not. Bankers really are paying that level of tax. And of course, 47% is not the right answer, because that is paid from a pay packet that's also subject to employers' national insurance, now at the intensely stupid rate of 15%.
Yeah.
So given that that is economically borne by the worker, a highly paid banker is suffering economically an overall rate of tax of something like 54%. Seems to me they are adequately taxed, possibly, dare I say it, overtaxed. What's their main expense going to be? Well, their biggest expense is going to be buying a house. When they buy a house, they're going to pay SDLT at a marginal rate of about 10%. Again, that seems really quite a high level of tax. So our banker, who could be extraordinarily wealthy, I think is overtaxed. I think it would be wrong and damaging to tax them more.
Very good. So you heard it here first, yeah.
So one of the problems with the wealth tax is that banker, having paid really a lot of tax on their income, a lot of tax on their stamp duty to buy their major asset, is then paying wealth tax again, even though they've already been quite adequately taxed.
Yeah.
So no, that wealthy person, not overtaxed. Take someone else who inherits a very large amount of money and does so in a way which isn't subject to inheritance tax. And the things are about to change on that front, but historically there were lots and lots of ways you could take advantage of the loopholes, exemptions, relief and inheritance tax to receive that money tax-free. You could then invest that money in such a way that you're getting a return which is possibly not taxed at all if you're clever enough, or taxed at the low capital gains rate, which was 20% and now 24%.
Yeah.
Someone like that, I would say, is undertaxed. And we can go further, because there are people who do very similar jobs to our poor overtaxed banker, like someone in private equity, who receives their remuneration in the form of capital gains, even though it isn't really a capital gain, and they are paying tax currently, and now this has just changed, but I think currently at the rate of 34%, which is a lot less than the 50-something% the banker is paying. So then they, I think, are also undertaxed. So some of the wealthy are either adequately taxed or overtaxed. Some of them are undertaxed. If you create fancy new taxes on the wealthy, on all those people, you're doing an injustice, which may or may not bother people. But if someone is treated unjustly, they tend to respond in quite a disproportionate way. So even if you don't feel sorry for that banker, you should be concerned about the consequences of moving his effective tax rate from 54% up to 75%.
Yeah,
I think you should. What you should instead be doing is thinking about the individuals and the techniques that are undertaxed and remedying that. Now, that's kind of boring and technocratic, and it's much sexier to have grand utopian solutions about taxing other people and raising vast sums of money. And that's why my message is always going to be less popular than the wealth tax. But it's also why the wealth tax is never going to be implemented. And all the people spending their time on it are wasting huge amounts of resources, talent, and money on a pointless endeavour. And I wish they'd do something more sensible.
So something more sensible, perhaps. I know when you wrote about capital gains tax ahead of the budget last year?
Yes.
I think you were saying that capital gains tax is simultaneously too high and too low. What did you mean by that?
So let's say I invest £1,000, £100,000. Let's make it £100,000.
Why not?
Makes math easier. I invested £100,000 10 years ago. Today, I have £150,000. I'm going to be taxed on £50,000 of capital gain. But hang on a second, inflation over that period has been about 35%. So of my £50,000 of gain, really only £15,000 of it is real gain. But I am now going to pay tax at the current rate of 24% on my £50,000 gain. So I'm going to be paying tax roughly equal to my real gain. My effective rate of tax is close to 100%. That's madness, because capital gain taxes notional, fictional, illusory inflationary gains. On the other hand, if I'm someone who didn't invest £100,000 years ago, I'm going to receive £150,000 of income, but I'll get some accountants and lawyers to magic it into a capital gain. Then I'm paying tax on that at 24%, and my effective rate is 24%. So people with real capital gains pay a much higher rate of effective tax than people with fake capital gains. And that's, it's irrational, stupid and unfair, which people may not care about, but it disincentivizes investment, because I am not going to invest £100,000 if I think that any real gain I make is going to be taxed away because of inflationary gains. And of course, any loss I suffer, well, that's on me. That doesn't feel like a fair deal.
So give me an example of how income is magicked into capital gains. I think I've got an inkling of what you mean by that, but for our viewers and listeners, how might that typically work? What kind of example would you give?
Well, people have used all kinds of artificial structures to do it. My favourite one is the one the Beatles did back in the 60s. So the Beatles back then suddenly made a huge amount of money and realised to their shock that the rate of tax in the UK at that time was about 96%. And they're paying a huge amount of tax, and they did not like that very much. What they decided to do, what they were advised to do, was to sell their music rights to a company called Northern Songs. They then listed Northern Songs on the stock market and sold their shares in Northern Songs. And instead of just tootling along receiving royalties taxed at 96%, they would get a big lump sum payment, which was a capital gain. And at that time, the rate of tax on capital gains there was no tax on capital gains.
Yeah.
So it was a massively clever deal. And pretty much as soon as they did it, legislation was introduced to stop people doing that kind of thing. And there's been a battle ever since between people trying to create capital gains out of nothing and people, HMRC, the revenue, trying to stop them. Today it's hard, but it can certainly be done. One obvious way to do it is, let's imagine you set up Sam Incorporated, and you're going to invent a new widget or something. And you work for years for Sam Incorporated, and Sam Incorporated is doing really, really well. Do you pay yourself ongoing dividends from Sam Incorporated? It would be taxed at the top dividend rate of 39.35%? Probably not. What you do instead is you sell the company. Because if you sell the company, you're making a capital gain, taxed at a much, much lower rate. In fact, the most tax advantageous thing you could do is leave the UK, go and live in Monaco for 5 years, and then even though you built up the company here, spend all your life working for it here, that capital gain is completely outside UK tax.
And so maybe not taxed at all in that case.
And not taxed at all. And that the reason why tax exiles are a thing in recent times is mostly not people escaping income tax, because most countries, aside from taxation, have income tax, and people tend to feel that income tax is something they're okay paying. I'm not a psychologist, I can't tell you why.
Right.
But capital gains, people seem to have a different emotional reaction to. So it's exceptionally common for an entrepreneur soon making a sale to move abroad, sell their company, and cash out free of tax.
Yeah. I think there is an argument. This is probably not what is in such people's minds, but there's an argument that capital gains on corporate assets, on shares, maybe it shouldn't actually be taxed because it represents the sort of the present value of past income streams and future income streams, both of which will in fact be taxed. And the capital gain itself, to tax that too, would be a kind of double taxation that discourages people from investing or from building up businesses. Do you have any, and this I think is probably one of the big arguments between the sort of what I might call the kind of the centrist approach to tax reform, sort of IFS and Murley's review and everything, and then the more radical free market end of the spectrum. I think actually those two schools are in more or less the same place on most aspects of tax reform. You get widespread agreement. Probably where you get disagreement is around inheritance tax, and that will be sort of a principal point of whether it's right to tax inheritances or not. And then around the taxation of savings and investments, so capital gains and everything else, whether actually doing that just creates a tax bias against saving and investment that makes us poorer in the long run. And in effect, so it's a long-winded way of saying, I think the most radical free market approach is that really the tax base should just be consumption for everything. How do you respond to that?
So I think economists left and right would agree that whilst all taxes have an adverse impact on growth, consumption taxes have the least. The reason why in the modern world we almost certainly can't move to a pure consumption model is that the rate would have to be stupendous. What would
well, that's right.
80% rate of consumption. So unless you're able to shrink the state to an astonishing degree, I fear it's a non-starter. The argument for whether we need a capital gains tax at all, I mean, I'm quite sympathetic to the idea that in an ideal world where people are saints, then we shouldn't have a capital gains tax. Right. The problem is that you then create the same incentive the Beatles had to magic income into capital gains. You end up with an arms race to stop them, which creates a huge amount of complexity. So New Zealand, say, doesn't have a capital gains tax, but they have such a history of people manufacturing gains, they've almost created, in fact, they have created a kind of shadow capital gains tax, all the rules that take what you think is a capital gain and say, no, it's income. And that's not really a better place to be in. So I think I'd try and persuade even the most ardent free marketeer that in the real world, where people aren't angels, we need a capital gains tax.
Right. And it's better than all of the anti-avoidance stuff you'd have to go through to stop it.
Yes, it's better than that. But we certainly should make capital gains tax so it doesn't deter investment. And right now, taxing inflationary gains, it absolutely deters investment.
So I think that the proposal you made on capital gains tax was that you would more or less align the capital gains tax rate with the income tax rate. You might bring the income tax rate down a bit and align at a slightly lower level. You'd introduce a rate of return allowance. So let's say 5% a year would be free capital gains tax, and the excess of that would be taxed. And also, I think that any losses, any capital losses, and presumably those would be losses not against sort of scratch, but against the rate of return.
Exactly.
You would be able to offset your other tax liabilities that way. And I think in so many respects, this seems like a much better system than the one we've got at the moment. At least it's a more principled and more rational system.
Which is why everybody hates it.
But that can be a problem as well, can't it? But I think the reason people hate it, and in the piece you wrote about this, you addressed this point, but I'm not sure if you really got into why people hate it so much. I think it's how it would relate to entrepreneurs. So people who are making investments, buying shares, say, and then selling them, this seems like a sensible system. It would be a massive tax increase on people who, as we've just talked about, start a business, work for that business, and then sell that business and take the capital gains. They might pay a relatively low rate at the moment. They would pay a very high rate under the system you're proposing. And I guess your argument would be that that's fair because they've been disguising their labour income.
Correct. That's the classic economists out of this line.
And so I certainly see that from an economic neutrality standpoint. But I also wonder, surely entrepreneurs are taking on a lot of lifestyle and financial risk by choosing to go into business for themselves rather than go and work for a big company. Is that something that should be reflected in the tax system? If entrepreneurship was taxed completely equally to being a corporate drone, and there's nothing wrong with being a corporate drone, of course, would it deter, would it reduce entrepreneurship to an unwelcome level?
Gosh, I mean, I've got good friends who took enormous risk as entrepreneurs, leaving large companies, starting out with nothing, and it could have gone nowhere, and it took them years before they made it. It's fair. Yeah. I also have friends who are doctors or criminal barristers who left successful careers, took an enormous risk, got into a highly competitive field with no assurance their years of training would ever get anywhere. So the idea that you bet years of underpaid labour on an eventual payoff is not unique to entrepreneurs. I'm unconvinced we should tax it differently. But yes, for the reason you say, there are many on the right who deeply dislike it. Because I am giving a rate of return allowance, there are many on the left who hate the proposal as well. In fact, don't get reading past the first paragraph. So it is undoubtedly the least popular proposal I've ever published. I think it's also...
That's the one you've had the most pushback from both sides. People disagree with it.
I've been accused of being a neoliberal and a communist for writing the same piece.
It's true. You sound slightly proud of that, and I think perhaps you should be. Okay, so let's talk about pro-growth tax reform. What would be your number one pro-growth tax reform?
So pro-growth tax reform can be hard, but identifying the current anti-growth features of the tax system and killing them seems relatively easy. You don't have to look very far. So let's start with income tax. So someone earning £100,000 pays a marginal rate of income tax, as in the tax they pay on the next pound they earn, of 62%. If they're a graduate, 69%. Once they earn £125,000, their effective rate drops to 47%. That's more if they're a graduate paying off the student loan. But hang on. So I absolutely get that some people think we should have a top rate of 62%. I don't agree, but it's a view. It's a coherent worldview. But explain to me what the coherent worldview is that we charge 62% between £100,000 and £125,000 and 47% after £125,000. Why? So that is mad. And the problem with rates of 62% is that they are highly disincentivizing. You can reach that conclusion either by poring over the stats on sort of taxable income elasticity and the evidence as to the point at which the Laffer curve becomes real and people really do, their income drops in response to tax. Or you can just talk to people. You can find that psychologically there is something important about tax rates over 50%, and I don't know what it is. People seem to react very, very differently to them. So I've known and spoken to many people, and I get hundreds of emails from people who turn away work to avoid getting into the £100,000 point. And this, 62%, this is the best possible outcome at £100,000. The worst possible result is much worse. The worst possible marginal tax rate is something like 20,000%, because all the wonderful free childcare and subsidy the government's been giving you vanishes like that when you earn £100,000.
You pretty much have to earn 145, 147,000 to get back where you started.
I think it's a bit more than that now, but yes, there is rationally someone taking up these childcare schemes, particularly in London, would be mad to earn between £100,000 and £140,000. So people don't.
Yeah.
What do they? So some people do by accident. Again, it's with the Beatles. Maybe you get caught once, but then you learn.
Yeah.
And people use salary sacrifice schemes to make additional pension contributions. But for someone in their 50s, that could be quite attractive. But for someone in their 20s or 30s, it's just not very attractive to work maybe another day a week in exchange for income that you won't receive for 40 years.
Yeah.
So often people don't work another day a week. It's a particular problem in the NHS when NHS consultants, junior consultants, are right at the level where these rules start kicking in.
Yeah.
And the big question is, do we just have anecdotes that people are doing this? Or is there actual evidence in the data that when incomes approach £100,000, people are deliberately earning less? And the answer is there is data, there is evidence. There'll be more on that. I can't talk about that now. There'll be more on that coming out soon.
Interesting.
And that takes us from why should I care about someone earning £100,000 to is there actually an impact on all of us? And I think the evidence will show there's an impact on all of us.
Interesting. This is something that Tax Policy Associates is doing some work on?
There's some other people who we collaborate with who are doing some work on.
Okay. All right. Well, that'll be very interesting. Yeah, I mean, there are a whole host of these kind of things in the tax system.
Cliff edges.
Cliff edges. So we talked about the withdrawal of the personal allowance and childcare. Of course, there's the high income child benefit charge, withdrawal of like the personal savings allowance and the marriage allowance, and probably a number of other things that I haven't thought of.
We're about to have the winter fuel allowance in there as well. So
okay, that will be an extra one, won't it? Do you think that the way we make tax policy in this country is partly responsible for this kind of mess?
No, because it's completely responsible.
Okay, completely responsible. Right, because we do tax policy as an act of political theatre. So once or twice a year, we expect the Chancellor to pull some rabbits out of the hat to generate front page headlines. And normally it seems to me what happens is they have a clear idea of the positive thing that they want to do, and then they have to work out how do we fund it. And often this is a last minute scramble in the Treasury ahead of budget day, thinking, how do we make the sums add up and hit the fiscal rules? Oh, well, what if we just withdraw the personal allowance from people earning over 100,000?
It'll hardly affect anyone.
It'll hardly affect
anyone.
No
one's going to notice. It's a nice little solution. It's a little temporary thing, not messy, but that's fine. Yeah,
exactly.
So we end up with...
And then here we are 15 years on. It's still at 100,000. Been lots of inflation. A lot more people earning that amount of money.
Yeah.
Also, the personal allowance is, what, more than twice as large as it was at the time?
Yeah. I giggle rather darkly at Reform UK, who proposed greatly increasing the personal allowance, not realising that absolutely knackers the marginal tax of people on £100,000. So, yes. Right. So that rabbit 15 years ago is now joined by a succession of other rabbits. each of which have grown and become uglier and furrier as the years go on. And you end up with all these little gimmicks and complications in the tax system, which are never fixed because they're never particularly urgent. It's not a crisis. It's not on the front page of the newspaper. It's not even that widely understood by journalists or by the media as a whole.
Yeah.
So more and more rabbits accumulate, and eventually the tax system is just pure rabbit. And if you chart the income tax marginal rate, and again, plug for the Tax Bar Associates website where we have an interactive marginal rate calculator, you see a curve that is the stuff of nightmares. It looks like the battlements of a badly drawn castle.
So what percentage rabbit is our tax system at the moment? Would you care to put a number on that?
Well, once you get to £100,000, it is pure rabbit.
Pure rabbit, okay.
As someone was talking to me the other day, could we do this, or could we pay for this or that by lowering the point at which the 45% additional rate kicks in for £125,000? The answer is no, you can't, because £125,000 isn't a point at which tax goes up. It's a point at which tax goes down.
Yeah.
So it's just pure rabbit, and it's a problem when it comes to ossifying rabbits in the tax system, but it also means that any new proposal you come up with is going to create more and more of a mess.
Yeah. I'm going to push you on progress tax reform.
Yes, more progress tax reform.
So you talked about sort of the personal side of tax. I think that makes a lot of sense. Now, my guess is, and tell me if I'm wrong, that the big ones for you might be a complete overhaul of property taxes and corporation tax reform. Am I right?
VAT. I think
VAT too. Okay, yeah.
So VAT, it's a point first identified by those left-wing radicals at the Adam Smith Institute.
Yes.
Who located a chart that had been published by HMRC, but no one had really noticed, looking at how many companies you have at different points, different turnover brackets. So as you'd expect, there's loads of micro companies and there's a few big companies. What shape is the curve between them? Is it going to be a sort of smooth thing like that? Is it going to be a line? Well, what it turns out to be goes along for a bit, and anyone listening is going to be confused by this, but you're missing a wonderful multimedia presentation. After going along for a bit, it suddenly drops off a cliff edge.
Yeah.
With a little bulge before the drop. And that bulge, that cliff edge, that drop, that's the VAT registration threshold. Because if I'm a plumber, say, I'm tootling along, I've got £89,000 of business, I'm doing fine. If I get £90,000 of business, I have to charge VAT. And I probably don't have any inputs, so that is going to be a direct 20% cost to me that I'm going to pass on to my customer. And that's a problem, because my mate next door, who's still at the £89,000 point, isn't charging VAT, and it's going to be 20% cheaper than me. Yeah. So rationally, I would be kind of mad to do that. What I'm going to do is I'm going to hold myself back from £90,000. How do I do that? I can play the game a bit. I can make sure I don't buy stuff and sell it to customers. I get them to buy their own kit.
Right.
I will certainly not take on a plumber's mate, an apprentice, or anything like that. I will try and manage things best I can. And if I start approaching that 90,000, I will go on holiday. So I will stop work in February or March. Yeah. And this is happening on a large scale, and you see it in the data. And there's something like 30,000 micro companies which are intentionally holding their growth back. And there's been some great research on this showing that, I think from the University of Warwick, showing that that is not evasion, people fiddling the figures. It is a real effect. So the tax system has incentivized people not to grow their business. And that is mad.
Yeah. I mean, we talked about your most controversial, most hated tax reform idea, capital gains tax. I mean, I think mine, and I still keep wheeling it out to much the same response, is radically broadening the VAT base.
Totally.
In fact, basically going full New Zealand and trying to have a 100% VAT base, where we're at about 45%.
We're one of the lowest in the world, I think.
Yeah, exactly. So that what do they call it? The VAT revenue ratio. So we have one of the narrowest VAT bases in the developed world. VAT, in theory, is a relatively efficient tax. As you said, a lot of economists think that tax and consumption is the least bad thing for economic growth. So, in theory, you could make our VAT base comprehensive. You could double the revenue you're getting from VAT at the given rate, or of course, you could bring the rate down. Broaden the base, lower the rate. But you could theoretically produce oodles of new revenue, which basically funds the wish list for everything else that you want to do. The problem, of course, is the distributional effects, because it would appear to be regressive. And so you have to offset that somehow. Oh, well, you're not sure.
Well, so let's take, for example, the VAT 0% on children's clothes.
Yeah.
If I suggested to many people, certainly anyone on the left, that we should abandon that, they would think that's very regressive. I think those people should go to the Harrods website, look at the children's clothes, look at the £18,000 gold lame children's jacket with 0% VAT, and ask themselves just how progressive it is that we have effectively a subsidy on that. Doesn't seem progressive to me. Now, yes, there are people on low incomes who would be harmed if you scrap the 0% on children's clothes and did nothing else. So an obvious thing that you do is you uprate child benefit by the average cost to people of eliminating the 0% on children's clothes. So if you did that, you would have money to spare.
Yeah.
So to me, the political economy of it is that it would be challenging to make this change to raise revenue for government. I think you have to do it on a neutral basis. You're saying, okay, well, we're doing this. You're going to pay more VAT unless you're on very low income, but we're going to bring the rate down.
Yeah.
So everyone should more or less be flat, and it's a more sane system. And you do it to children's clothes, you do it to food, you do it to heating, which is a good environmental benefit too.
Yeah.
And it's never going to happen, but it would be. It absolutely would be rational tax policy, and I'd like to think everyone rationally across the political spectrum could agree that it is a rational tax policy to implement.
Yeah, I mean, I think when I looked at this, and I won't remember the precise numbers, but I thought that probably about half of the revenue increase you would have to put towards offsetting the impact on lower income workers. And if you took that amount of money, you could probably make sure, at least on an aggregated basis, that no one worse off than kind of the average income would lose out as a result. That still gives you a significant amount of revenue to do all of the fun stuff that you may want to do as a tax reformer. And of course, it's much easier to do tax reform if you're cutting the taxes at the same time, because there are more winners, fewer losers. And
the winners tend not to parade in the street waving banners.
That is unfortunate. Yeah, one day we'll get a parade and people will go out to celebrate our tax reforms. Okay, so that's VAT. So we're in agreement, right? We do a very broad-based VAT.
Yes.
We maybe lower the rate, maybe keep it the same, and maybe do some other stuff with the money.
I think you have to lower the rate.
Yeah. Okay. Corporate tax, property tax.
So property tax is another one where I fear we're going to agree, but it's challenging to do. So stamp duty land tax is just a disaster, but it raises a lot of money. So it cannot simply be repealed. And if you did repeal it, what you'd also do is have an immediate bump in property prices, particularly high-value property prices, which I think is undesirable. And I mean, it would create a windfall for current owners, make property. You wouldn't be creating a benefit for first-time buyers or anyone like a first-time buyer. So I don't think that's the right way to proceed. You can solve both those problems at the same time, the affordability problem and the price raise problem, by replacing stamp duty land tax with an annual land value tax, which is another of these policies that tax wonks across the political spectrum think is a good idea. Politicians across the political spectrum think is an awful idea, and they can't possibly sell it.
Yeah, well, I remember, I think, talking to someone at the Treasury about this, and you'll have heard much the same thing. I think it's, why don't we just tax property values on a recurring basis? Every economist thinks this would be much better, and that stamp duty is a disaster. And they say it's like that old joke about asking the guy, why do you rob banks? Because that's where the money is.
Yeah.
And people who own high-value properties don't necessarily have the liquid cash lying around to pay the annual property tax. At least this would be the argument.
Yeah.
Whereas when people are making a property transaction, in a sense, large sums of money are changing hands anyway. They might resent it, but they don't resent it nearly as much as they would pay the annual rate on an ongoing basis.
But of course, that resentment is part of the point of a land value tax. The land value tax, one of its main objectives is to encourage the efficient use of land. And someone living in a property that they cannot afford to pay 1% a year on, in economic terms, that is not a very efficient use of the land. And yes, people will say, but we are maybe asset rich, but we're cash poor.
Yeah.
The label for someone who is asset rich, cash poor is rich. They're rich. And if they turn their mind to it, there are many ways in which they can use their asset to raise the cash. So I would The politician's answer to this conundrum is, oh, well, let's roll up the land value tax and not make it annual. Let's collect it when they die. And then you're creating horrible bastardized capital gains tax and inheritance taxes out of what should be a pure and sensible proposal. Right. So no, I really think that the tax only works and only achieves its objective if you close your eye to that complaint and really make it an annual tax.
What do you think of this idea of phasing in that transition?
You have to.
Right. So, and the way I mean that particularly is as properties change hands, there won't be stamp duty paid.
Yes.
And then the new owner will start paying the annual land tax instead.
That kind of rule, which people used to call grandfathering, we've seen quite a lot in tax. We've seen it particularly with, I think, with enterprise allowances, these massive tax benefits for holding land, weirdly in Canary Wharf, but only on existing leases because it was phased out. So the answer is that people just hold on to assets, hold on to leases for far longer than they should, which is economically suboptimal. They enter into artificial arrangements, so they kind of continue to hold it, but kind of don't. It all becomes a mess. So no, I do think you need to phase in a change. How do you do that? One way you do that is you credit for stamp duty paid. So, for example, if someone just paid a fortune in stamp duty when they bought a house, it's a little bit unfair if you now ding them for a large amount of ongoing property tax and say, hey, but don't worry, we've cut stamp duty. Right. So they're not benefiting. So you need to credit the stamp duty paid.
Yeah.
You probably also need to phase it in over a period of years to avoid disruptions to the market. So probably what that means is something as simple as stamp duty is phased out 20% per year, the land tax is brought in 20% per year.
Yeah. Okay. Interesting. And business
never
rates?
Going to happen.
And that's never going to happen either.
Business rates, business rates are very badly broken. I was just speaking to someone who was buying a property or was going to buy a property. Did discover that the business rates on that property were equal to about 10% of its market value.
Right.
Making completely uneconomic. So business rates and the way business rates valuations work are a significant problem.
Yeah. All right. Well, I think we'll wrap up fairly soon. But I want to ask you about my favourite topic in tax, maybe yours too, full expensing.
Full expensing, yes.
We have it, don't we?
Well, and much credit to the IEA and others for banging a drum for years thanklessly and eventually got us full expensing. So full expensing being the idea that when you invest in plant, machinery, industrial buildings, there's another tax system just allowing you to get tax relief for the purchase price over many years. You should get it all up front.
Yeah.
So that you're no longer disincentivized from making a large investment. And that's great. We have it, and Labour committed to keep it, which is also excellent. But it only applies to some things. It only applies to plant, machinery, industrial buildings. It would be much more powerful if it applied to everything.
Yeah.
It would also reduce a lot of avoidance and eliminate a lot of complexity in the tax code. But as ever, there are trade-offs. That would be an expensive thing to do. It would also lead to a slightly odd situation where you could borrow in order to buy an asset, and then you're getting a deduction for buying the asset and a deduction for your borrowing costs. So I think the quid pro quo from an affordability and a fairness perspective is that interest deductions would have to be significantly curtailed.
Yeah. And that would obviously offset some of the revenue loss as well. Do you have potentially all of it?
The IFS have done the numbers on this.
Have they? Okay. I'll have to look at that. I mean, because that seems to me to be a good thing on both fronts, actually, removing the debt bias in the tax system and getting rid of the bias against capital investment.
It'll be an enormous simplification. There are so many tax rules dealing with the debt bias, saying essentially you're allowed to use it so far but no further.
Yeah. But what will corporate tax lawyers do in this idealised world?
I mean, it's rather unfair for me to have a great career as a tax lawyer and then try and put tax lawyers out of business, but I really am trying to do that.
Okay.
We should be looking at the areas where tax lawyers spend a huge amount of time and add a huge amount of value dealing with complexities in the tax system and ask, well, hang on, why do these complexities exist? Is there actually a reasoned justification for them? Or are they just rabbits, accidents of history, accidents of chancellors' sound bites, which are preserved in aspect for decades and decades? And I think much of the time they are that. And we could achieve a great deal of simplification at no cost to the public purse if a chancellor or a bunch of gifted politicians and gifted tax geeks sat down in a dark room with a red pen, just crossed a bunch of things out.
Yeah.
Accompanied by blood-curdling threats if anyone tries to take the mickey and take advantage of those rules being removed.
All right. Last question, maybe a two-part question. there's all this speculation at the moment that the government will have to raise taxes in the autumn. Well, announce tax increases in the autumn, probably to take effect for the next tax year, in order to meet their fiscal rules. So supposedly there is a fiscal black hole. We don't really know how big.
There's always a black hole.
That black hole is. So I won't ask you to sort of cost this out precisely, but the question is, if tax raises increases are necessary, and obviously coming from the IEA perspective, we'd always prefer that spending was reduced. But let's just take politics as a given, and they're going to have raised taxes. How should the Chancellor raise taxes, and how do you think she'll actually do it? If you're prepared to gauge into the crystal ball.
So let's assume that they have to raise £5-10 billion from tax. How do you do it? And there's two ways you can do it conceptually. One way is to scrabble around and find lots of little taxes you can raise here and there, loopholes you can shut, techniques you can close. And before the last budget, so we published a list of about 40 ways that you could do that. And it's kind of ugly, but most of those you can do without really that much economic damage. It's a bit complicated. It also has the slightly ephemeral effect of maybe creating an atmosphere that lots of taxes are going up.
Yeah.
But that's one way you do it. The other way you do it is you put up one of the big taxes. And politicians in a bind, that's what they do. In 1992 and 2010, the Tories went into the election saying, oh no, we're not raising VAT. And there is VAT. This government went into the election saying we're not raising tax on workers. They raised tax on workers with employers' national insurance. So that is the easy, guaranteed, simple way to raise tax. Which of those would they raise? VAT is regarded in the Labour Party as a very regressive tax. I think that's wrong, but I don't know why it's VAT. Corporation tax, we're already really quite toppy with corporation tax, and you'd have to raise it by quite a lot to raise a lot. So I think not that. Income tax. If you're going to do one of the big taxes, putting a penny on income tax is probably a pretty good thing to do.
Yeah.
But
we should say a percentage point, just so people don't get the wrong idea, right?
Yes, everyone will just pay 1 penny more. Thank you. Putting a percentage point on the rate of income tax.
Yeah.
And that would be probably the most honest way to raise tax. I'm not sure they'll do that. I mean, if it was very much for increased defence expenditure, a penny on income tax for Ukraine seems to me a viable political proposition, but I'm still not sure they do that. Employers' national insurance, would they go to that same well again? I think probably not. So have I just ruled out all the possibilities? I think I have. I'm not very good at this.
We haven't actually ruled out employee national insurance contributions yet. Well, I mean, probably the same applies as income tax.
Yes, a bit less understood and therefore abused by politicians. People think it's not a tax. So spoiler, it is a tax. So I think I'm saying the most plausible is probably the bits and scraps of lots of little tax increases and loophole closings.
Yeah. Which unfortunately can backfire because I guess you get concentrated benefits to these things, and the people who lose out get extremely angry, whether they're people who eat a lot of pasties, in George Osborne's case, or people with family farms or whatever this time around. So it does very much feel like there are no easy options for a government that wants to raise money, given where we are at the moment.
I'm sure that's right.
Yeah. On the other hand, there is a lot of great thinking going on pro-growth tax reform, and actually a great deal of agreement across a relatively wide political spectrum about the broad principles that should be employed, even if there's some disagreement over details and, of course, overall rates of tax.
But I think that's right. I think that you could have someone on the left who thinks overall tax should be, 45% of GDP, someone on the right who thinks it should be 30% of VAT.
Yeah.
Both of them can agree that whilst the rate, they might argue about, the base, the thing that the rate is applied to, should work in a sane, rational way. And I think those people and think tanks across the left and right would agree that VAT should not have a cliff edge, that income tax shouldn't have cliff edges, that corporation tax shouldn't be stupendously complicated, and that land tax is broken. And these are areas where people across the political spectrum can, I think, reach a consensus. And part of the mission of Tax Policy Associates is to try and push those issues and hope that people with different political views can come together on them.
Yeah, absolutely. Well, Dan, good luck with that. And thank you very much for joining us today. I've hugely enjoyed our conversation.
Thank you very much, Sam.